Welcome back. All right, today is not just a gold price show. This is a demand show, a market behavior show, a credibility show. Because something happened in gold that is bigger than a flashy headline, bigger than a one-day rally, and honestly, bigger than the number on the screen. Gold crossed a threshold that tells us the market is being used differently now. Not perfectly, not smoothly, and not without corrections, but differently. And as we get into it, it is Tuesday, May 19th in New York. Drop a comment and tell me what day and date you're watching from. And if you value the work I do here, support it by subscribing and commenting Our John Ag. Now, here's the key point. Gold demand did not merely rise. It pushed into territory the market had never formally recorded before, with annual demand moving a little over 5,000 tons, and the value of that demand landing well above $500 billion. Based on recently published numbers, that was not one narrow pocket of buying. It was investment demand, central bank demand, retail physical demand, and a much larger financial conversation all building at the same time. But let's slow down, because this is where people get careless. A record demand year does not automatically mean gold can only go up. It does not automatically mean every pullback is fake, and it does not automatically mean buyers should stop thinking and start chasing. In fact, gold already gave the market a reminder of that this year. After reaching a fresh historical high early in the year, it went through a sharp setback. Not a tiny wobble, a real correction. And that matters because strong assets can still fall hard when positioning gets crowded, yields move against them, or traders suddenly need liquidity. That is actually the first reason this milestone is important. Gold kept attracting capital even after proving it was not a straight-line trade. It became more visible, more liquid, and more central, but also more contested. That combination is what makes this story worth paying attention to. So what changed? I think the better question is, what changed first? Was it price pulling people in? Was it investors losing patience with paper promises? Was it central banks deciding they wanted an asset with no one else's liability attached? Was it the rise of easier access through funds and smaller products? The answer is not one thing. It is the stack of all of those things landing together. Start with investment demand. Last year, gold-backed funds pulled in close to $90 billion, and holdings climbed to around 4,000 tons. That meant these funds represented roughly 1/6 of annual demand. That is a massive presence for a category that can move quickly when sentiment shifts. And even after the market stumbled this year, global fund holdings had rebounded by spring and pushed above the 4,000-ton neighborhood again. That tells you something. Interest cooled, yes. It did not disappear. Now, I want to challenge one idea that gets repeated too casually. People say gold is only a crisis trade. War hits, gold rises. Fear cools, gold falls. Clean story, easy story. But the latest cycle does not fit that neat little box. Gold has responded to stress, absolutely. Yet the bigger move has also been about portfolio construction, currency concerns, and the search for assets that do not rely on someone else's balance sheet staying trusted forever. That is a different argument from simple panic buying. And look at the official sector. Central banks bought a little under 900 tons last year. That was still historically strong, even though it slowed compared with the prior year. That detail matters. The buying pace eased, and yet demand as a whole still reached a new zone. So this was not a story where central banks single-handedly dragged gold over the line. They mattered, a lot, but private capital mattered too. That balance is important. Then there is the United States. This part gets under-discussed. U.S. gold demand more than doubled last year, and much of that increase came through fund buying. American gold-backed holdings moved into record territory, sitting around the 2,000-ton area. That is not some fringe corner of the market. That is a sign that institutional and semi-institutional demand in the world's deepest capital market became much more serious about gold exposure. According to the latest publicly available filings, the first quarter of this year did not look like a collapse in demand either. Total quarterly demand still increased modestly from a year earlier, while the value of that demand jumped dramatically because the price base was so much higher. Bar and coin buying also posted one of its strongest quarterly readings in years. So even while higher prices pressured affordability, a meaningful group of buyers kept choosing ownership over hesitation. Now, does that mean high prices never hurt demand? No, of course they do. Jewelry demand is usually the first place where resistance becomes visible. You cannot keep lifting the price of a luxury or cultural purchase forever and expect volume to behave as if nothing changed. Some buyers delay, some downsize, some shift toward lighter products. That is normal. And I think the honest view is this. Gold demand is broadening, but not every part of the market is equally comfortable at these prices. That brings us to physical buyers. When a full 1-ounce coin starts feeling like a serious financial decision, smaller formats naturally matter more. fractional products begin to carry a different kind of relevance. Not because people suddenly love smaller coins for no reason, but because access has to meet reality. If an asset moves far enough upward, the market adapts by breaking the ticket size down. We have seen that before. We are seeing it again. And this is why the growth of smaller market tools matters. A 1-ounce gold futures contract was introduced as a more accessible trading product, but let's be very clear, that is cash-settled exposure, not the same thing as holding a 1-ounce coin in your hand. Those are different use cases. One is a market instrument, the other is direct possession. Investors need to understand the difference because access is not the same thing as ownership, and convenience is not the same thing as control. The broader industry knows that too. That is why there is so much discussion now around digital gold, shared infrastructure, and systems that could make fractional ownership easier to issue, transfer, and verify. From recent market updates, the idea is to create a more trusted digital layer around gold without pretending the physical metal no longer matters. That is a big distinction. A digital claim on gold is only as credible as the custody, the legal structure, and the redemption path behind it. And here's the skeptical side. Digital gold could become a useful bridge for smaller investors and for financial applications like collateral or settlement. It could also become another area where marketing runs ahead of trust. Standards matter. Audits matter. Legal clarity matters. Regulators are paying closer attention to tokenized financial instruments more broadly, and that should tell you this whole field is still developing, not finished. I would be careful with anyone presenting digital gold as if all questions have already been solved. And there is one more thing. The easier gold becomes to own, the faster investor behavior can shift. That can strengthen demand during confidence-building phases, but it can also magnify reversals when too many people crowd into the same trade too quickly. Access cuts both ways. That matters a lot. Still, the fact that the conversation exists is important. Gold is no longer being treated only as something locked away in a vault and discussed once per crisis. It is being pulled into product design, payment architecture, portfolio models, and collateral conversations. That does not erase its older role. It adds another layer to it. If you're successful, share your success story in the comments so others can stay motivated. Now let's step back. Gold has spent thousands of years being trusted precisely because it is difficult to manufacture, difficult to debase, and not tied to a single government's promise. But the modern gold market is not ancient history. It has evolved repeatedly. Americans regained broad legal freedom to own gold decades ago. Bullion coin programs grew. 22-karat coins became familiar. Later, 24-karat U.S. options expanded the menu. Every time the market built a new bridge between gold and ordinary buyers, participation changed. So when people ask why gold demand is reaching new milestones now, part of the answer is that access is more layered than it used to be. You have physical bars and coins. You have large funds. You have futures markets. You have smaller derivatives. You have digital experiments. You have national reserves. You have private households. That does not mean all demand is equal. It means the audience for gold is wider. And it is not just a Western story. Asia still matters enormously. Demand patterns across India, Southeast Asia, and the broader region influence how gold is accumulated, gifted, saved, and traded. In some places, investment buying has remained resilient even while higher prices slowed traditional jewelry behavior. That is a subtle but important shift. It suggests gold demand is not disappearing under high prices. It is changing shape. Singapore has also continued building its role as a major bullion and trading center, and that points to something larger. The gold map is not fixed. Market infrastructure follows capital, trust, logistics, and regulation. When those elements improve in a region, that region can become more influential in setting habits, flows, and standards. But again, I do not want to overstate this. A changing map is not the same as a complete transfer of power. It is not as simple as saying one side of the world is taking over and the other side is fading. Gold is too global for that. What we are seeing is a market where demand leadership is becoming more distributed, and that can make the system more durable, but also more complex. Now let's talk about the part people often ignore when they celebrate record demand: supply. Gold supply did improve a little in the first quarter, and recycling rose in the mid-single-digit range. That is exactly what higher prices tend to encourage. More old jewelry comes out, more scrap becomes worth processing. More marginal material finds a bid. So the system does respond. This is not a frozen market where only demand moves and supply sits still forever. That is the counterweight. If prices climb far enough, they awaken supply responses. Maybe not enough to flood the market, but enough to matter at the margin. And those marginal ounces can influence short-term pricing, especially when investor positioning is stretched. So if someone tells you demand records automatically erase correction risk, I think they are leaving out half the conversation. The macro backdrop also matters. Recent policy language has continued to emphasize uncertainty, especially around inflation risks and geopolitical spillovers. At the same time, longer Treasury yields have recently been elevated, and that can pressure gold because non-yielding assets compete with instruments that suddenly pay more. This is one of the reasons gold can fall even during tense periods. Investors do not always buy safety in a single direction. Sometimes they sell what they can, raise cash, and rethink later. That is why gold's correction this year should not be dismissed. It was information. It showed that momentum had gotten crowded. It showed that liquidity still matters. It showed that even a strong structural story can be interrupted by short-term market mechanics. But here's the other side. The correction did not erase the demand milestone, did not erase the ETF rebound, did not erase the continued official sector interest, and did not erase the fact that quarterly demand value stayed extremely strong. So I think the real milestone is not just that gold crossed a historic annual demand line. The real milestone is that gold now has several independent demand engines operating at once. Official reserves, fund flows, retail bars and coins, regional investment cultures, product innovation, financial infrastructure experiments. Those are not all equally powerful every month, but together they create a very different foundation than a market driven by one headline at a time. And that changes the questions investors should ask. Instead of only asking, will gold be higher next week? Ask, who is still buying after the rally? Ask, which parts of demand are price sensitive and which parts are strategic? Ask, are fund inflows returning after corrections? Ask, is recycling rising enough to soften the squeeze? Ask, are new products making gold more accessible or merely packaging it differently? Those are better questions because they separate excitement from structure. My own view is that gold's milestone is a big deal, but not because it guarantees a straight climb from here. It is a big deal because it confirms gold has moved deeper into the operating system of modern finance. It is now more visible in reserve strategy, more accessible in investment wrappers, more discussed in digital infrastructure, and more important to ordinary buyers who are trying to protect purchasing power without pretending the world is perfectly stable. And if you think that sounds bullish, yes, in a broad sense it is. But bullish does not mean careless. Bullish does not mean buying every spike. Bullish does not mean ignoring corrections, yield pressure, or affordability constraints. The stronger the asset becomes, the more discipline investors need, not less. So as we close this out, here's the bottom line. Gold reached a milestone that matters. Demand pushed into a new range. Investment flows proved far more important than many expected. Central banks stayed engaged. U.S. participation expanded. Retail behavior adjusted. Digital infrastructure moved further into the conversation. Asia remained deeply relevant. And through all of it, gold also reminded everyone that a powerful long-term case can still come with sharp short-term discomfort. That is the real story. Not hype, not denial, structure. And as always, this is for education and market discussion only. It is not personal financial advice, and it should not replace your own judgment, your own research, or guidance from a qualified professional who understands your situation.